Our money growing in our bank accounts is one of the biggest lies banks tell us. The truth is that while money increases in quantity due to interest, it does not increase in value or in real terms because of skyrocketing inflation and lagging bank interest. In reality, keeping cash in the bank will burn a hole in your pocket. In this video, we'll outline 6 resources that you may use to halt wealth erosion and foster intergenerational wealth. 1. God's money, gold, silver, and platinum. Money is utilized to hold value for the future, which is one of the main factors that makes it valuable. To pay their deficits, governments today, however, continue to print additional money. Therefore, you can never predict when the dollar bill would lose all of its value. This is why financial gurus advise investing in valuable items that are hard to come by and make. This is the main justification for why wealthy people always keep a percentage of their portfolio for precious metals. The value of precious metals like gold, silver, and platinum will always increase as inflation soars through the roof. A troy ounce of gold cost $400 prior to the 1950s. The same ounce costs more than $2,000 in 2023, and according to PrimeXBT's gold projections, this will rise to $10,000 by 2032. Your gold assets will be worth 5 times as much then as they are now, which is in around 10 years. Thus, gold continues to rise as cash continues to decline. Similar to gold, other precious metals are preferable to keeping money in a bank. You can invest in gold ETFs if you're wondering how to add gold exposure to your portfolio without purchasing physical gold. Without needing to hold physical gold, gold ETFs are very affordable investment instruments that provide returns based on changes in the price of the GOL. 2. Industrial commodities, raw materials. The preciousness of precious metals is not only due to their scarcity but also their essential utility in various industries. Silver, for instance, is vital in electronics, medical devices, and nuclear reactors. Similarly, metals like cobalt, nickel, and copper are in high demand due to their unique properties, especially in making batteries for electric vehicles. To illustrate, the demand for cobalt has surged since 2020, leading to a 100% price increase from $20,000 to $40,000 per ton by 2022. Investing in these raw materials can significantly enhance your portfolio during high-demand periods. However, acquiring these materials in large quantities or finding suitable buyers is challenging for many. Hence, investing in mining company stocks like Rio Tinto, specialized mutual funds, or financial instruments like futures and options provides excellent exposure to these valuable resources. 3. Safe haven currencies. In today's world of fiat currencies, where no currency is backed by gold, the stability of a country's geopolitical situation plays a crucial role in investment decisions. This is why wealthy individuals opt for Swiss banks. Switzerland, known for having one of the most robust economic systems globally, provides a stable geopolitical environment. Consequently, the Swiss franc becomes a safe haven asset during times of uncertainty and unrest. This pattern has been observed repeatedly. For instance, during the Eurozone debt crisis in 2009 and the global financial crisis in 2008, significant funds were transferred to Switzerland from affected countries to safeguard wealth from currency devaluation. Moreover, the Swiss franc serves as a valuable substitute for the US dollar in international trade. During recent events like the Russia-Ukraine crisis, where the U.S. imposed sanctions on Russian energy trade, Russia turned to the Swiss franc for transactions. This surge in demand significantly increased the value of the Swiss franc against other currencies. In early 2023, 1 Swiss franc was equivalent to 1.1074 US dollars, leading to substantial wealth growth for Swiss franc holders practically overnight. Consequently, stable currencies like the Swiss franc, British pound, and Chinese yuan are excellent stores of value. However, since not everyone can open Swiss bank accounts, smaller investors can still gain exposure to these currencies through currency ETFs and forex brokers such as Forex.com, with investments starting as low as $100. 4. Sovereign guarantee. Have you ever closely examined a dollar bill? You might have noticed the phrase, "This note is legal tender for all debts, public and private." Ever wondered about its significance? Since 1971, when President Nixon eliminated the gold standard, the dollar gained its status as legal tender according to U.S. law. This made it valuable for transactions, and we began accepting it as an equivalent repayment for goods and services. Even though no fiat currency in the world is backed by gold or any physical asset, they are perceived to have value due to the trust and credibility of the government. Essentially, the stability of your money depends on the stability of the government supporting it. That's why investing in sovereign guarantee is seen as a secure way to preserve value. Governments are typically the last entities to default. If a government defaults, the entire nation faces economic collapse, something no strong government would allow. Hence, one of the safest methods to invest in sovereign guarantee is through government securities or G-SECs. However, it's crucial to invest in stable government G-SECs with high credit ratings. Remember the sovereign debt crisis in Greece in 2009? Organizations like the IMF, Eurogroup, and ECB had to rescue the country from its financial crisis multiple times. Therefore, when investing in G-SECs, it's essential to consider the overall strength of a government in the global arena. In the U.S., you can invest in treasury bills, notes, and bonds to gain exposure to sovereign guarantee. These options offer better returns than simply keeping your money in the bank. Moreover, they are backed by the U.S. government's robust standing in the global economy. Small investors have the option to purchase Treasury securities directly from the government through the Treasury Direct portal or from the secondary market. 5. Value stocks and mutual funds. Investments in government bonds do offer better returns compared to holding cash. However, these returns are lower than what stocks can provide due to their low-risk nature. While minimizing risk is crucial for those cautious about investments, most investors are driven by the pursuit of higher returns, making stocks an appealing choice. It's important to note that not all stocks pose the same level of risk. The stock market is typically categorized into value stocks and growth stocks. Growth stocks, particularly in the technology sector, are riskier because they involve innovative ideas and technologies that might fail. On the other hand, value stocks like Nucor, dealing in established industries like industrial metals, carry lower risk due to consistent demand. These value stocks not only ensure steady and predictable price growth, but also offer reliable dividends. However, extensively researching each value stock can be time-consuming and challenging for average investors. That's why dividend-focused mutual funds like the Vanguard High Dividend Yield Index Fund Admiral shares, which have a stable history of dividend payments, are excellent and budget-friendly investment options for individual investors. 6. Land and real estate. Accountants regard land as an asset that doesn't depreciate, and there's a solid reason for it. Land is scarce and always in demand. Throughout history, land has been one of the world's most valuable resources, essential for various purposes such as housing, education, industry, agriculture, and commerce. With the global population increasing, the demand for land remains constant. Additionally, properties like homes, offices, and commercial spaces constructed on land are always sought after. Consequently, both land and real estate serve as excellent safeguards against inflation in your investment portfolio. Consider the statistics. A study by Bloomberg revealed that housing prices tripled between 1992 and the 2020s, even after a significant drop during the 2008 housing crisis. This illustrates the value of having investments in real estate, especially when the dollar's value is decreasing. However, many small investors tend to overlook real estate until later stages of their lives, often associating it solely with their residences. While owning a fully paid-up home is a financial milestone typically targeted in one's 40s, it's advisable to have a stake in the retail property market at any age. Contrary to common belief, substantial capital isn't necessary to enter the real estate market. There are accessible avenues, such as real estate investment trusts, REITs, which function akin to mutual funds, but specifically for real estate. In the U.S., Ventas Incorporated, VTR, is a prominent REIT, focusing on healthcare real estate, encompassing senior housing, research facilities, and hospitals, among others. Alternatively, you can opt for borrowing to invest in rental properties. The rental income will cover expenses, mortgage payments, and even yield profits. These methods enable investors to gain exposure to the real estate market without requiring substantial initial investments. Thanks for watching. If you found this information beneficial, we appreciate your support for our channel. Kindly show your support by liking, subscribing, and turning on notifications for the next video. Bye.